Section 1. The Double-Edged Coin. An introduction to Bitcoin's wild ride. In 1 year, a modest investment could have bought a new car. In another, it might have evaporated into digital dust. A single headline could send its value soaring toward the moon, while a whispered rumor could cause it to plummet back to Earth in a matter of hours. This was the dizzying, often contradictory, reality of Bitcoin. For some, it was the sound of a new financial dawn, a tool for economic freedom and empowerment. For others, it was the deafening noise of a speculative bubble, a high-stakes gamble destined to end in tears. The world watched as fortunes were made and fortunes were lost with breathtaking speed. Section 2. The Genesis Block. A quiet revolution begins. The story of Bitcoin begins not with a bang, but with a whisper. On January 3, 2009, amid the global financial crisis that had shattered trust in banks, a mysterious individual or group known as Satoshi Nakamoto mined the first block of the Bitcoin network. That Genesis block contained a hidden message, a London Times headline: Chancellor on brink of second bailout for banks. It wasn't just a technical footnote, it was a statement of purpose. A quiet declaration against a broken, opaque, unfair financial system. Satoshi's white paper months earlier proposed a simple, revolutionary idea: Bitcoin as a peer-to-peer electronic cash system. One person sending money directly to another, without any intermediary. No bank, no credit card company, no government. The system would be run by a decentralized network of computers operated by volunteers around the world. Decentralization was the key. No single entity could control the currency, manipulate its supply. Section 3. From pizza to price spikes, the first stirrings of a market. For years, Bitcoin remained a fascinating but purely theoretical concept for most of its users. It was a solution in search of a problem, a currency with nothing to buy. That all changed on May 22, 2010, a date now immortalized in crypto folklore as Bitcoin Pizza Day. 2 large pizzas in cardboard boxes. A programmer named Laszlo Hanyecz made a post on an online forum offering to pay 10,000 bitcoins to anyone who would order him 2 large pizzas. A teenager in England accepted the offer, ordered the pizzas from a local shop in Florida, and had them delivered to Hanyecz. This seemingly trivial event was a monumental milestone. It was the first time Bitcoin was used to purchase a tangible good, proving it could function as a medium of exchange. This simple pizza transaction planted a seed. It demonstrated that Bitcoin could bridge the gap between the digital and physical worlds. Slowly, the idea began to spread beyond the tight-knit community of coders. Section 4. The Great Bitcoin Boom. When the world took notice. The period between 2017 and early 2018 marked a profound shift. Bitcoin exploded from the fringes of the internet into the global mainstream. What was once a slow, steady climb became a near vertical ascent. The price didn't just rise, it skyrocketed, multiplying over tenfold in a single year. Suddenly, Bitcoin was no longer a niche topic for tech enthusiasts. It was the lead story on major news channels. It was the cover of international magazines. It was a constant topic of conversation at dinner tables and office water coolers around the world. This massive price appreciation created a new class of ultra-wealthy individuals, the crypto millionaires. These were often early adopters, programmers, savvy young investors who had bought or mined Bitcoin when it was cheap and held on. Their stories became modern fables of instant wealth. Social media feeds were filled with images of them posing with Lamborghinis, lavish mansions, exotic travel destinations, all paid for with digital currency. These stories, amplified by the media, created a seductive narrative. Anyone could get rich. This was their chance. The hype cycle fed on itself, drawing in a massive wave of everyday people. At the peak of the boom, the atmosphere surrounding Bitcoin was electric with a mix of euphoria and anxiety, The conversation was no longer confined to whether Bitcoin was a good investment, but how high it could go. Price predictions of hundreds of thousands or even $1 million per coin were thrown around with serious conviction on primetime TV and in mainstream financial publications. Celebrities and prominent business figures endorsed cryptocurrencies, lending an air of legitimacy and glamour to the market. Every day, a new story emerged of someone who had turned a few $1,000s into a fortune, reinforcing the once-in-a-generation narrative. This period was dominated by speculation over fundamental use. Bitcoin's original purpose was peer-to-peer cash, but high fees and volatile price made it impractical for everyday purchases. Not people buying coffee, but people buying Bitcoin to sell later at a higher price. The market was driven by short-term traders, algorithmic bots, and amateur investors chasing momentum. Just as quickly as it had ascended, the Bitcoin market came crashing down. The peak was followed not by a gentle plateau, but by a brutal and prolonged collapse. In a matter of weeks, the price shed more than half of its value, and the decline continued for months. The descent was punctuated by days of extreme panic, where prices would drop by 20% or more in a single 24-hour period. The euphoria that had defined the boom was replaced by a pervasive sense of fear and desperation. The headlines that once celebrated crypto millionaires now chronicled catastrophic losses and the bursting of the digital bubble. The panic selling was a mirror image of the panic buying that had preceded it. Investors who had bought in at the peak, driven by FOMO, now rushed to sell at any price to salvage what was left of their capital. The slick smartphone apps that had made it so easy to buy now became instruments of panic selling. Exchanges were overwhelmed with sell orders, sometimes causing their systems to crash and locking investors out while their portfolios dwindled. The very same social media platforms that had amplified the hype now became echo chambers of despair, filled with stories of ruin and angry accusations. There was no single cause for the crash, but rather a confluence of factors that finally broke the market's momentum. Concerns about government regulation were a major catalyst. When countries like China and South Korea announced stricter rules and potential bans on trading, it sent shockwaves through the market. The constant news of hacks and scams also eroded confidence, reminding investors that their digital assets were not always safe. Ultimately, the overhype itself was a primary cause. Prices detached from intrinsic value, driven by the belief someone else will pay more, the greater fool theory. The aftermath of the crash revealed the profound human impact of Bitcoin's volatility. The story was not just in the numbers on a chart, but in the real lives that were irrevocably altered. On one side, there were the early believers and disciplined investors who had managed to secure life-changing wealth. These were individuals who had bought in when the price was low, held on through the volatility, and had the foresight to take some profits during the boom. For them, Bitcoin was a success story, a validation of their early conviction. They paid off mortgages, funded their children's education, or retired early, their lives transformed by their digital investment. However, for every story of incredible gain, there was a story of devastating loss. Many of the people who were hurt the most were the ones who had arrived late to the party, buying in near the peak when the hype was at its loudest. These were not wealthy speculators. They were ordinary people, nurses, construction workers, small business owners who had gambled their savings on the promise of a quick fortune. When the crash came, they saw their financial futures evaporate. The emotional toll was immense, leading to stress, depression, and strained relationships as families grappled with the consequences of a high-risk bet gone wrong. The stories that emerged were deeply personal and often heartbreaking. There was the young professional who had poured his entire savings, and the factory worker who had taken out a high-interest loan. Many felt foolish and ashamed, having been swept up in the collective mania and convinced by the pervasive get-rich-quick narrative. In the years following the Great Crash, Bitcoin did not disappear as many critics had predicted. It entered a new phase, less manic hype, more mature development. The departure of short-term speculators, fair-weather investors, allowed the market to stabilize, albeit at a lower price point. The ecosystem that remained, a more committed group, developers, long-term investors, businesses, focused on building sustainable infrastructure, real-world applications. Major financial institutions began to take it seriously. They launched custody services, trading desks, investment products for institutions. Exchanges improved security protocols, compliance measures to prevent hacks and failures. Regulated futures markets, other financial derivatives gave investors tools to manage risk, added legitimacy, attracted cautious, well-capitalized investors. Despite this maturation, the fundamental debates surrounding Bitcoin continued to rage. Supporters, often called maximalists, doubled down on Bitcoin as digital gold, a long-term store of value, a hedge against inflation and geopolitical instability. On the other hand, critics raised concerns: extreme price volatility, unsuitable as a day-to-day currency, significant environmental impact from energy-intensive mining. Today, Bitcoin occupies a complex, contested space, a more mature, more regulated, perpetually debated digital asset that continues to challenge our traditional notions of money. If the story of Bitcoin's euphoric rise and painful crash teaches us one overarching lesson, it is a timeless lesson about the relationship between opportunity, risk, and human psychology. Bitcoin presented a genuine opportunity, a paradigm-shifting technology, with the potential to create a new asset class. However, this opportunity was inextricably linked with immense risk. The extreme volatility created overnight millionaires, and it also wiped out the savings of countless others. It was a high-stakes global demonstration that high rewards are almost always accompanied by high risk. The saga showed how market psychology can overwhelm rational analysis. The boom was not driven by sober assessment. It was an emotional cocktail of greed, hope, the fear of being left behind. The crash was fueled by fear, panic, despair. This cycle showed that markets are driven by people who are prone to cognitive biases and herd behavior. The experience forced a practical education: volatility, diversification, market cycles. When all the noise of the price charts, the hype, and the horror stories fades away, what is the lasting legacy of Bitcoin? When all the noise fades away, the price charts, the hype, the horror stories, what is the lasting legacy of Bitcoin? It is not the Lamborghinis or the bankruptcies. It is not the promise of a decentralized utopia or the reality of a speculative asset. The single most important thing that Bitcoin changed was the conversation. For the first time in generations, it forced millions of ordinary people, along with governments and the world's largest financial institutions, to stop and ask a series of fundamental questions. What is money? Who should have the power to create and control it? And can we trust the systems we have? Before Bitcoin, the nature of money was issued by governments and managed by banks. Bitcoin challenged that monopoly. It presented a working alternative, however flawed. That alternative was based on mathematics and a distributed network rather than on central authority. This new conversation spurred innovation, forced legacy systems to adapt, provided a lifeline under hyperinflation or oppression, and elevated decentralization from fringe concept to paradigm. In the end, the story of Bitcoin is less about success or failure and more about the power of a provocative idea that permanently altered our perception of what money is and what it could be.